Welcome everyone to Vested Interest. This is Shane, and this is our weekly portfolio update. We do this every Sunday morning, well, typically on Sunday mornings. I did add $906 in new capital to the portfolio, so we will cover what I bought with those funds, any dividends we received, options we were in for the week. Whenever I make sales, I cover that as well. I think it's important for those of us in this space talking about finances and investing to show our portfolio. So I do that on a weekly basis. So hopefully that gives some of you out there who maybe have recently started a portfolio and are seeing some of the ups and downs, the red that happens in a portfolio, that you get the comfort level and the confidence to know that if you've done your due diligence and they're good stocks, that doesn't necessarily mean that you run out and sell them. And maybe for some of you out there who have not started your portfolio, give you some confidence that you too can do your own investing, start your own investment journey, and hopefully follow along on this journey to financial freedom, because that is what it's about, eventually reaching financial freedom. Now, before we get too far in the video, if you would take a couple seconds of your time and help out the channel by hitting all the buttons down below, hit that thumbs up button if you find any value in the content. Make sure you're subscribed. Join us on this journey to financial freedom. Join the Vested Interest community. Click the notification bell so you're notified whenever I put out any new content, along with this weekly portfolio update video series. I do a stock pick of the day video series Monday through Thursday. We take a look at a company that's pulled back on the day, run it through my screener, see if it makes it onto my watch list. There is the thanks button down below for anyone who might want to buy me a cup of tea and help out the channel financially that way. Really appreciate all of you who view the channel and the subscribers. A special thank you to all of you out there. The channel continues to grow because of people like you. All right, options. No options this week. Actually, last week and this week, I did not even attempt to run any options. I've got a lot going on, both of my daughters in sports with work and everything else, just coming off vacation. So I did not throw out any options, just like last week, nothing really to speak of from there. Dividends, on the other hand, have been coming in, and we did receive a payment on July 23rd from Comcast Corporation, ticker CMCSA. This is out of the communications sector. Paid us $107 even there, and we do have the drip set on the portfolio, so that just means anytime a company or ETF, index fund, whatever it is in the portfolio pays out dividends, they get reinvested back into the same fund or dividend stock. In this case, the $107 got reinvested in about 3.00224 more shares of Comcast Corporation. Those three and a little bit over shares added $3.96 in passive income over the next calendar year. And we also received dividends on the 25th from Cisco Corporation, ticker SYY. This is out of the consumer staples sector, paid us $83.50. And again, we have the drip set dividend reinvestment plan, and that $83.50 went right back in and picked up 1.04362 more shares. And when you hear people talking about the dividend snowball effect or compounded interest, this is really what they're talking about, right? We've taken funds and already bought shares of Cisco Corporation. So we own those shares outright. Those shares pay dividends, right? Those dividends get reinvested. Those reinvested shares add additional capital. And then the other way the snowball grows is when Cisco raises its dividend over time, right? Those are the ways that that dividend snowball keeps accumulating. And the longer we do that and let time compound, the larger that snowball will grow. So passive income added from this 1.04362 shares bought by the drip, $2.25. We get into the new capital added here on July 21st, which was Monday. We added $511.58 to the portfolio. With those funds, we picked up 2 shares, adding 2 additional shares to our Valet position, ticker VALE. Picked up those 2 shares at $10.10. Valet is out of the materials sector. Picked up 2 shares of Schwab Strategic Dividend Growth ETF, ticker SCHD. 2 more shares at $27.01. This is the ETF, typically part of my weekly buys, but I just feel like the market's kind of run up a bit. There's not a lot out there that I feel like is fair valued or undervalued, so I'll add a little bit more to SCHD. I have no problem doing that. United Healthcare, we added 1 more share there to UNH. This is out of the healthcare sector. $281.99 is what we picked that up. I like this under $290. It is a bit above my cost basis, but I still feel like United Health is undervalued, even with all of the issues that they are going through right now. This one is one. So long as it stays under around 295, 290 or lower, I will probably continue to add a share or so here over the next several weeks. Procter & Gamble, same thing. I feel like this is around fair value. Procter & Gamble, ticker PG, added one more share there at $155.38. Like this one, under around 160, and we'll probably continue to add to that one as long as it is around 160 or lower. Passive income added from the $511.58, and the new shares picked up $16.64. We went back into the portfolio on the 25th, which was Friday, added $394.54 in additional capital. With those funds, we just went in and bought our weekly buys. We do this every week. These two ETFs, we add about 3 shares of SCHD and 1 share of VTI. Again, every single week, regardless of what the market is doing, I'm going to continue to dollar cost average into these for at least the rest of this year, if not next year and going forward. We'll see how it goes. And so 3 more shares to Schwab Strategic Dividend Growth ETF, ticker SCHD here at $27.17, and 1 more share to Vanguard's Total Stock Market ETF, ticker VTI, and 313. This is, the market is overvalued in my opinion, has really run up. I said last week or the week before that 309 was the most I'd ever paid, and it's a new record this week at $313.04. So the market is, in my opinion, a little frothy. I'm hoping for a bit of a pullback. Excuse me. But we'll continue to add to these 2 ETFs every single week regardless. This $394.54, the new shares picked up and added an additional $6.76 in passive income over the next calendar year. So total invested this week, $906.12. Total passive income added, $29.61 total. Quick run through the sector weights here. Communications makes up 9.88% of the portfolio. Consumer discretionary at 2.97. Consumer staples makes up 8.75. Energy sits at 9.76. Financials right here makes up 2.42. I want to talk through financials a little bit here towards the end of the video. I may be making a little bit of a switch in this sector, but we'll talk about that here in a little bit. Healthcare at 17.75% of the overall pie. Industrials makes up 6.53. Technology is the second largest piece, right behind healthcare at 16.67. Materials at 2.34% of the pie. That's really just the valet position there that we continue to add to. Utilities at 3.75. REITs and real estate at 5.99. Would love a pullback on Vici, and I would add a significant amount there, but haven't seen that yet. I really like it back down in the 30s, but it might be something I'd add to in the $31 range. And ETFs is quickly becoming one of the largest positions in the portfolio. Currently sits in the number 3 spot with 13.18% of the portfolio, and eventually this will be the largest slice of the pie just by the nature of adding the VTI and SCHD every single week. Over to the right, you can see the same sector weight percentages that matches up to the pie, as well as the dollar amount allocated as well. Now here it is, and I do show this every week. Again, as I mentioned in the beginning, I think it's important for those of us in this space to show you that we are really investing so you can see what we are doing, a real portfolio built out over time so you can see the ups and downs of the market holding ETFs like VTI and SCHD, as well as individual stocks, and we do have some REITs in here as well. So want to show you what it really looks like, because you do have pullbacks over time, right? Comcast Corporation is right now it's down 14.1%. So if I was someone who didn't know what I was doing, maybe just getting started in the market, didn't really know how to come to a discounted cash flow analysis on what the company might be, I might look at that and say, oh my goodness, I need to sell it because it's down. But to me, it looks like a better buying opportunity than when I was buying it at $39.21. I think Comcast is still a good company. I think the fundamentals of the company are intact. It is still growing. It's still relatively cheap, in my opinion, based on what I estimated the position at, or the company at here. So I continue to nibble and add to this and try to bring down my cost basis, right? So that is the reason for me showing this. Again, I want you to see a real portfolio built out over time and the ups and downs associated with that. So in this column are all the different tickers, all the positions in the portfolio, total share count. All of these numbers will be as of the close of business on Friday. Actually, Saturday morning is whenever I got in here and did the update. So we'll say Saturday morning around noon. Total shares in this column, current price as of the close of business on Friday or Saturday morning, market value here, average cost per share here, purchase price here. Now, the average cost per share and the purchase price does include reinvested dividends, as does total return, which is in this column. Percent return, you're going to see it. If I'm up or down, I want to be fully transparent so you can see there are going to be times where positions are in the red. As you can see, what is there? 1, 2, 3, 4, 5, 6 positions currently in the red, anywhere from down 14% to down only 3%. It happens. And if the companies, again, are still fundamentally sound, they still meet the criteria you set up whenever you bought them, they're still around the price that you think that you should be buying, just because there's red doesn't mean you should be running out to sell the positions. It actually is the time you should double down and try to buy more, bring down that cost basis, bring up your potential future returns. It seems to me investing is one of the few places, or maybe even the only place, where people see a sale and they think that the product that they were going to buy, in this case stocks, ETFs, REITs, whatever it is, closed-end funds, business development companies, whatever it is in the red. They think I can't buy that, or I need to sell that, or it's not a good price now that it is pulled back. Well, that is not necessarily true. Again, my job as an investor, in my opinion, your job as an investor, is to find those times when the stock's fundamentals get disconnected and the value of the company get disconnected from the stock price. They are two different things. There's the company and the fundamentals around the company, like revenue growth, margins expanding, that sort of thing. And then you have the stock price, which a lot of times are influenced by emotions, by negative news that might come out, by any range of things. People just deciding that they want to switch from communication sector to technology sector, for example. Maybe they see a better opportunity out there. So there's a lot of different reasons to sell. And just because a stock is in the red is not one of them, unless the fundamentals of the company have deteriorated or it's no longer meeting the criteria that you have set up. Or, there are times where it might be a good time to pull the trigger and say, I have better opportunities in this position, and lock in a loss. But that would be up to you to make those decisions, right? But just because something is down is not a reason to sell. And again, the stock market seems to be one of those few places, if not the only place, where someone sees a sale, which sometimes that's what stocks in the negative are, and they run out of the store, which is the stock market, and decide I'm not buying, or I need to sell because it's in the red. All right, which sector they fall in here, whether they're a quarterly, monthly, semi-annual payer. In this column, how much they pay, and then you can see those highlighted in yellow have already raised their dividend for the year. And you can see I did update Union Pacific. Last week they raised their dividend. I think it was around $1.34 before, up to $1.38, another around 3% raise. So we captured that one. I think I am up to date now. Still waiting on a few companies to raise their dividends. Ally, I don't expect them to raise their dividend. I just looked at their payout ratio recently. It's about 150%. So it looks like they have paused the dividend over the last several years, and that is probably the reason why. Now, I do want to talk about this here in a second because I may be making some changes on this one, but let me get through the rest of this here. Current yield in this column, yield on cost here, portfolio weighting, how much of a percentage of each individual position was. What we saw on the previous slide was the percentages of each sector. I do have a rule in the portfolio. I do not want any one position to be more than 10% of the portfolio. I do not want any one sector to be more than 20 to 25% of the portfolio. Estimated annual income in this position, in this column, payout months here, dividend growth year over year. This does get adjusted as they adjust their dividends, right? As you can see, I adjusted Union Pacific, so this does bounce around from time to time based on the adjustments that they make to their own dividend growth year over year. And where a company sits at 15% of a 52-week low, I want my average cost per share, average share price, to be at or lower than 15% of a 52-week low. So let's talk through that using UNH. My cost basis on United Healthcare System is $270. I added one share to this week, above $270. But below, it was at $281 and some change. It was still below at $281, 15% of a 52-week low, which is $286.21. So I can continue to buy so long as the share price is below 286, or so long as my average cost per share is below 286. Let's say if the price per share, right, still at 281 and some change. Let's say if this jumped up to 290, which would be above the 286, but buying one or two more shares would not bring my average cost per share above 286 if I was buying at 290. So hopefully that gives you an idea of what I use this column for. Again, I want my average share price to be at 15% or below 15% of a 52-week low for my positions. So total shares, 7,607.89 shares. Market value of the portfolio, $390,589.73. Purchase price, what I have into the portfolio out of pocket, that does include reinvested dividends, $351,597.05. Total return, $38,992.68. I am up 11.09%. Nice to see, but I do not focus on total return or the percent return that I am up, because unless I sell out of all these positions, I don't lock in this gain, right? You only lock in a gain or a loss whenever you sell the position. So it's nice to see that I'm up, but it's not something I really focus on. Now, I added this in a few weeks back, and I continue to show it. Here's portfolio salary. So the per month, per 12 months, I'm making $1,119.43 per month. Per week, that breaks down to $258.33. Per day in a 365-day year, $36.80. And I even broke it down by hour. This is every hour of the year, 8,760 hours. That would be $1.53. And even when I'm sleeping, right, my portfolio is making me money. That's what I'm trying to show you with this breakdown here. Current yield is 3.439%. Yield on cost, 3.821%. And this is what I'm focused on. That's why it's circled over here in red. The dividends paid out by all the different positions in the portfolio, and it goes up week over week, month over month, quarter over quarter, year over year as I add new capital. As the positions in the portfolio raise their dividends, which again, we just updated Union Pacific raising theirs. As those dividends get paid out and we reinvest them through the DRIP, and it currently sits at $13,433.12. Dividend growth year over year is currently at 5.8%. Now, I mentioned Ally has paused its dividend. Now, they have paused their dividend so far for several years now. This is one I've talked about a few different times as a potential cut out of the portfolio if they did not start raising their dividend again. I'm getting pretty close to that, and part of the reason is I like my yield on cost, right? I am up significantly on this position, 47.83%. My yield on cost is much higher than where it currently is, 4.603%. So I don't really want to add to this position and bring my yield on cost down. I like where it's at, but I hate that they're not growing the dividend. Again, it's been set on 30 cents for, I think, 3 years, going on 4 years now. Definitely 2 going on 3 years, if not 3 going on 4. And I want growing dividends. You can see I only have a few positions, Ally being one. What is this? OHI, Omega Healthcare being another one. This is a read out of the real estate sector, but my yield on cost on that one is 9.184%. I can almost deal with no growth on 9.184%. Another one is AT&T. I knew that going in. They had just cut their dividend, so I knew it would be a few years before they started raising their dividend again. The other one is Valet, which recently cut their dividend also. So I haven't seen a raise on that one yet either. But Ally, and this is more recent. So new going in, AT&T was one that was 0% raise, but again, much higher at 6.4% yield on cost, locked in the 4.63 or 4.603. But I have been watching this one for several years now, and I've said it before that this one may be one, if they don't raise their dividend, I may look for something else. With a 47.83% return right now, I could lock in a significant return around $3,000 and roll this position into something else that is raising its dividend. I was actually looking at a company that I would potentially do that. I really was waiting, to be honest with you, for a big pullback on something like Visa or American Express or MasterCard, and I was thinking about swapping it out with one of those. But there is another company that I was looking at called Chubb. It is an insurance company. It is actually one that Warren Buffett recently added to his portfolio, and I thought about adding several years ago. whenever I first got into the market, but I really didn't know as much as I do now. And insurance companies were one of those that I really had trouble looking at and understanding. Since I understand them a little better now, it would be one I would be willing to add to the portfolio. It is raising its dividend, but I would definitely lose some yield here because its payout ratio is only, I think, in the 1.4% range. It is a little higher than where Buffett was buying it, and I think if I was to sell Ally, right, and roll this the $9,436.34 into it, I think I'd have around 34, 35-ish shares, right in that range, and I think I would lose, not quite $200, 150, 160, right, 150 to $170. I think whenever I was doing the math, I just did it on paper. Around $150 to $170 in estimated annual income, but I would pick up, instead of being 0% dividend growth, again, it's around 6% dividend growth, and it would pull me above 6% dividend growth. I would also, I believe, I think it dropped me down to 3.7% yield, so not a terrible drop in yield, a little bit higher dividend growth, but also, like I said, I would lose a little bit of estimated annual income. So I haven't pulled the trigger on it yet. I am really considering it, especially with Ally's payout ratio being above 150% right now. That kind of scares me. Are they just going to, I don't think they're going to cut the dividend, but I do think that they are going to maintain no dividend growth, which would be, definitely year 2, if not year 3 or year 4 for Ally. I believe we're going on year 3, if not year 4 for Ally not raising its dividend. So it's one I've been watching for a while and have kicked this around for a while, and I'm getting pretty close. I think I had a little bit above a 50% return here not too long ago. If Ally was to do another quick run up, I might look to sell it now. That Chubb is in a place right now where I would be comfortable buying, so that's part of the reason I'm thinking about it. So I may do a little bit more of a deep dive into these two and compare them side by side and see what I think overall. Let me know what you think about that. Again, thinking of selling Ally, locking in the return here, and rolling it into Chubb, ticker CB. Much more dividend growth, around 6%. Payout yield is only around 16%. So it's only in the teens, and it's growing its dividend around 6%. So I would lose a little bit of yield on cost. I would lose a little bit of estimated annual income. Around, I think it broke down to around $13 a month. But if I'm going to make the move, in my opinion, sooner rather than later would be better, especially with Chubb being around the cost I would be willing to pay for it. Let me know what you think of that in the comment section down below. Would love to hear your opinion on that as well. All right, well, that is it. As always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us on this journey to financial freedom. Join the vested interest community. I do personally read and respond to the comments. I am always interested to read your questions, opinions, or suggestions for future topics. Like I said, let me know what you think of swapping out Ally for Chubb. How is your portfolio looking? Are you, bouncing off all-time highs like the rest of the market? Are you selling anything right now, locking in some gains? Have you added any new positions? Love to hear from you what's going on in your portfolio. Who paid you dividends recently? Are you running any options? And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Thanks for tuning in. Hope you have a great weekend, and we will see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money. You should never invest any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice and counsel of a certified financial advisor.